Many of you know Calamos as a leader in the liquid alt space. We pioneered the first convertible bond mutual fund back in the 80s, and we've added numerous strategies over the years. Earlier this year, we introduced an illiquid alternative private credit interval fund. To support that launch, we teamed up with Aksia, a leading institutional investment consulting firm specializing in alts and with a particular focus on private credit. We're very excited about this product as it brings a truly diversified global institutional portfolio to a channel that could not get that exposure until now. We'll tackle private credit not from a Calamos Aksia product standpoint, but rather from an educational standpoint. For more on Aksia, let me turn it over to my colleague, Todd Trebacka from Aksia.
Thanks, Mike, and welcome everyone. Hopefully you'll find this webinar to be informative. Private credit is one of my favorite subjects. I'm super excited to talk about it. But before we talk about private credit, let's try to build some credibility with you all and talk a little bit about Aksia. Aksia is an institutional consultant. What does that mean? Well, that means that large institutions hire us to help them build alternatives portfolios, private equity, real estate, real assets, venture capital, hedge funds, and private credit. And you see in the fourth bullet point here, we work with over about 100 different institutional investors, 20 of the largest U.S. public pension plans. We work with insurance companies. We work with foreign public and private pension plans, and we work with sovereign wealth funds. We advise our clients on over $100 billion worth of assets across all alts. We advise on $80 billion in private credit, and we manage about $14 billion in behalf of our clients in private credit. So it's a lot of expertise. We think we have more than 30 professionals globally focusing on private credit. We have 7 offices worldwide. We have 42 risk professionals that focus on the risk of illiquid alternative assets. And then we have 60 professionals that focus on operational due diligence. These are the Madoff hunters. They're the ones who make sure that you don't fall into a fraud. Okay. Happy to be here. Mike, turning it back to you.
Todd, let me just ask one question relative to the role that Aksia has with sponsors. So a large state pension plan would hire Aksia as their consultant in the alternative space. And if they have an interest in private credit, they might ask you to be an advisor where you would look at the leading private credit managers, or they might ask you to be a discretionary manager. Is that correct?
Yes, and they might do both. We have clients that ask for our advice on finding the best private credit managers worldwide, and those same clients ask us to manage money in their behalf on a discretionary or non-discretionary or semi-discretionary basis. In fact, I work with a client in the Midwest where that's the relationship. We advise them on deploying over $2 billion annually in private credit. And at the same time, my colleagues in Asia manage a bespoke $200 million separately managed account focused exclusively on Asian private credit managers. So the answer is yes. And on top of that, we can do both.
And one last point is it fair to say that the largest private credit managers in the world, and it's kind of a who's list of asset managers in terms of the league tables, but the Blackstones, the Apollos, KKR, Carlyle, Goldman Sachs, they all offer private credit investment management to institutional investors, and you would review as part of your role. You would evaluate them both from a manager and from a performance standpoint. Is that accurate?
That's right. The governance on that our clients are subject to require our review, and really, I think the question is, okay, who does Aksia really see? Which GPs and which strategies are we most familiar with? And the fact is, like you said, I was just in Asia. Goldman Sachs Asset Management wanted to meet with me and my colleagues about private credit in Europe. We talked to the BlackRocks, we talked to the Blackstones, we talked to the Ares, and we also talked to the private credit manager, a first-time fund that's spun out of somewhere else and is looking to launch something. Our clients pay us to find the best risk-adjusted private credit returns everywhere in the world. And if that's BlackRock, great. If it's a first-time manager managing, a small amount of money but is very good, so be it. but that's our job. We have to boil the ocean to find the best ideas.
So Todd, let's begin with the idea that most of the audience is familiar and experienced with public credit. Why don't you define private credit so everybody's got a common understanding of what we're talking about?
Sure. There you go. It's a good lead in. I didn't even know that slide was there. So I'll do a quick overview. Credit, like you said, everyone knows, right? Or most people know. It's going to be debt instrument secured. It's going to have rights and seniority over equity. It's going to pay a current yield. All that you see in public credit, those same financial attributes, you'll also see in private credit. What makes private credit different from public credit are really a couple different things. Number one is these are bilaterally negotiated instruments. So unlike in public credit, where you have an intermediary, an investment bank that's hired to find the cheapest cost of capital, the most borrower-friendly terms, they're working for the borrower. So when you buy a bond, you're essentially buying, forgive me for any bond fund managers in the audience, you're buying something that was sold to the lowest common denominator. Forgive me. In private credit, that's not the case. The lenders and asset purchasers and structurers are acting on their own behalf bilaterally with the borrower or the asset seller. And that's really important because when they do that, private credit managers, point number two, maintain control over the tranche. It may surprise people on this webinar, but lenders have voting rights, and they have the ability to vote what happens with a credit, and that's very rarely exercised in the public bond land. Just like nobody ever votes their proxy when they own 2 shares of Apple, right? Same thing happens in the bond world. That's not the case in private credit. You have managers that are solely responsible for that credit. They can't trade out of it. They can work it. All they have to do, the only choice they have is to work it out. And as a result, they're paying very close attention and getting to the table faster and trying to get ahead of problems, which is why recoveries are so much better. We'll get to that, why recoveries are so much better in public credit. So it's the bilaterally negotiated nature and the fact that you have one manager focusing on the assets, not 1,000.
Interesting.
Yeah.
Next, within private credit, it's often grouped, as though it's just one sector. And in reality, just like in public markets where you've got sovereign debt, corporate debt, you've got high yield, you've got emerging market, you have the same type of subcategories in private credit. And many times direct lending, which is a type of private credit, is thought of as representing all of private credit, and it's actually much broader than that. Could you add some insight or help explain the different flavors, different categories of private credit, and some of their, how they differentiate from one another?
Yeah, absolutely. And you put your finger on it. I mean, some people in the audience might have heard of direct lending or private credit and conflated the two. That's very common practice. That happens all the time. And this is a battle that I fight to kind of break that equivalency. And there's a really good piece on the we sponsor an interval fund. If you go to the website, CAPIX is the ticker. But if you go there, you'll see a wonderful white paper about that private credit is more than just direct lending. And we have a second one coming out as well. And we at Aksia, this is our private credit map, and we think that private credit can break down into at least 6 different subcategories of similar risk. Similar within the category, but different from the others. And direct lending is only one of them. You've got distressed and special situations, specialty finance, real estate credit, real assets credit, and mezzanine. And these really aren't correlated to each other, which is why our clients, when they ask us to build private credit portfolios, usually want us to diversify across all 6. The magic, as I say, happens over here. You guys can see my cursor. It happens in everything to the right of direct lending. I'll give you just a couple examples. I don't take too much time because your time is limited. If you look at healthcare royalties, okay, the demand for a healthcare treatment, whether it's Lipitor, whether it's levothyroxine in my case, whether it's whatever, Ozempic, whatever it is, there's not a lot of correlation to the demand for that indication in the S&P 500. Another example is we have music royalties. How much Van Halen you listen to isn't really connected to the spreads of the of the Barclays Ag. Insurance-linked securities. If there's a connection between hurricanes in Florida and the Russell Index, let me know. And much of the same can be said for these other categories as well. So that's why kind of that diversification is really important. Look, private credit is going to get you 8 to 15%, 95% of the time. You might go a little more if you're lucky enough to get the right vintage. You might have a bad manager get a little less. But in general, it's 8 to 15%. And our view is if you're going to get bounded outcomes of return, you might as well diversify as much as possible when it comes to the underlying risk generating those returns. Does that make sense, Mike?
It does. What on the topic of default rate, public, we would all think relative to credit and what the default rate is. How does private credit compare to public credit default rates?
Look, Mike, I'm going to shoot you straight. Defaults are really hard to compare in private and public markets. And the reason is that private credit lenders, they'll be ahead of defaults. Let me back up. There's 3 definitions of default: bankruptcy, failure of payment of interest or principal, and a distressed exchange for a new instrument, but for one of the other 2 have transpired. If you're a private credit manager and you wake up and your business is in bankruptcy or missed an interest payment or principal payment, you should really be fired. And so private credit managers that's what they're good at: getting ahead of the problem, figuring out what can change, figuring out if they need more collateral or if they should have the owner of the business put more money in to pay them down. They're very good about getting ahead of those problems. And as a result, you're going to see default rates that are going to be a lot lower in the public markets, not because necessarily the companies are better. It's just that the lenders as stewards of that risk are more checked in and focused on what's going on.
That makes sense. One last thought is that within the various sectors in private credit, there are certain sectors that will perform, or the sectors will perform differently in different economic scenarios. Sure. Am I accurate in saying that? And thus there might be a time to own certain sectors and to rotate through those various sectors?
Let me find a good slide that indicates that. I think this is a good one, and so is this one. I'll tick through these 2 very briefly. So most of these silos can be identified as having certain types of specific risk. And so this is a good example. So if you're not feeling good about real estate, you might not want to be in real estate credit, and you might want to de-emphasize specialty finance that focuses on real estate. You might prefer real assets instead. If you don't like where the global corporate sector, maybe, or even in Europe or wherever domestically, if you don't like what you're seeing there, like I don't like what I'm seeing historically at the moment, you have other options as well. You can flex into consumer and real estate and real assets and other things. So there's that element to it. The other element to it is the performing versus the non-performing. One of the things that makes private credit interesting, and all credit, is you have the chance to pick up pennies for a dollar when you're looking, dollars for a penny rather, when you're looking at kind of distressed situations. And private credit takes that one further. It doesn't just deal in distress; it traffics in, rescue financings and DIP, or debtor in possession financings, and special situations. All of these things that can be counter-cyclical, and they actually thrive when the markets are off. So I think that's a good way to think about it. There's a lot to do in private credit, and we see our clients on the institutional side allocating to these different silos at different times, or emphasizing them at different times.
Todd, it seems like private credit is becoming a very popular investing category. What is driving the growth of private credit?
Sure. So let's talk a little bit about that. This is a real, there's the institutional demand for investors, and then there's the demand on the asset side. Let me cover the asset side first, and I'll go here. This is a very difficult graph to read, but it's accurate nonetheless, I promise you. What this shows is that what private credit did was it started to fill the gap left by banks who didn't want to lend. And that started way before the GFC, right? That kind of deregulation, that retrenchment started long before. In fact, some of the biggest private credit managers were names that my kids would recognize. General Electric was a huge private credit lender before the GFC. GMAC, General Motors Acceptance Corporation. So it's been around for quite a while in that front. In Europe, that's not the case. In Europe, in fact, the GFC was much more of the catalyst to transition to private credit. So the demand has really always been there on the asset side. In other words, borrowers looking for private credit. And the fundraising really came from liability-driven investors, so pension plans and insurance companies. And we all know what happened after the GFC. Rates went down to almost zero. You remember that, right? You're old enough to remember that, Mike, as am I. And so if you're an LDI-driven investor, right, what happens? The discount rate to your liabilities goes down, they go up, you've got to service them, there's a greater burden on you, but you don't have anything in the fixed income markets to help you. So what do? You turn to private credit. And private credit generally generates about 200 to 300 basis points over the public markets. Remind me to go to that slide, Mike, because I want to finish the thought here before I prove that out, before I demonstrate it, if not prove it. So private credit really attracted liability-driven investors. And by the way, this works for retirees too. Retirees are liability-driven investors, right? Pension plans are nothing more than plan sponsors for retirees. So an individual retiree can benefit similarly. And so that's really what drove that interest. In 2023, you see something really breathtaking. You see a market increase in fundraising in a high-rate environment. Now, why is that? Why would a liability-driven investor who can now go into the public markets, right, and service their liabilities much better, why would they be allocating to private credit? It sort of makes no sense, except for one thing, COVID. In 2020, institutional investors saw what happened to their portfolios, their public portfolios, their private equity portfolios, et cetera, on and on and on. And they saw what happened to private credit. Private credit was steady Eddie. It paid its coupon. It didn't hiccup, at least at the fund portfolio level. Sure, there was weakness at the borrower level, but in general, it outperformed. And as a result, you see the trajectory after 2020. So I like to say that institutions, Mike, came for the high yields, and they're staying for the lack of correlation, which gets back to my previous points about Van Halen, Lipitor, and Florida Hurricanes. The phenomenon, not the football team, yeah?
And one last question relative to the growth of private credit. Is there any reason to believe the growth, or what does the growth trajectory look like in the future? Likely to stay the same, increase, decrease?
Look, I think that we are pretty. This is going to sound really funny because there's been so much happening in private credit. But if you compare private credit to private equity, which is what this slide does, you'll see that private credit really isn't, that huge of a percentage of total alts. I mean, this line right here shows that, it's what, 20% of private equity, which is remarkable to me because private equity LBO strategies use 5, 6, 7 turns of leverage to execute their strategy. You would think that private credit would be a multiple of private equity. In fact, it's not. So as a result, I suspect that we've got room to grow.
Got it. Just to hammer home or to turn to the question of, understand what it is, different flavors, what the catalyst for the growth in the area, just from a foundation standpoint, as asset allocators evaluate private credit, what are the investment characteristics of private credit? And you've mentioned them a couple times, but let's just deal with that straight on.
Yeah, let's do that. I think this is the best. By the way, this is kind of this is the slide I referenced before. This is the discount margins and new issue spreads of public and private markets. Maybe we could do a better job presenting this, but I think it's fairly clear. The dotted line is the extra juice you get from being in private credit, and that's kind of what attracted liability-driven investors. But what do you get when you go into a private credit vehicle? And let's be honest, right up front, it's going to be illiquid. You have to tie up your money for some period of time. If it's a private equity finite live vehicle, you're going to be tied up for 7 years. If it's an evergreen vehicle, you might have semi-annual, annual, even quarterly redemptions. our credit fund, as you know, has quarterly redemptions, but there is an illiquidity element. I want to be fair and even-handed here as best I can as a private credit evangelist. But I think the real interesting thing is, first of all, what these private credit strategies can do and when they perform. Okay. They're all highly yield driven, which is great. It's a form of liquidity. It's income, which is great for retirees and others. Very little capital gains, so you're not worried about the markets. You're not worried about any event, and you don't feel bad when the market trades off. You're still getting your coupon. And there's some pretty good inflation protection too. Relative to the public markets, we at Aksia believe that the yields and returns are going to be higher in private credit. I just demonstrated that, or Indy showed it. The collateral diversification is going to be higher as well. I mean, we have one manager that buys post offices at an 8% cap rate. It's government risk at 8%. I mean, that's really good. That's really interesting. And there's tons of examples of that. Leverage in private credit tends to be lower. Again, why? Because in the public markets, you have intermediaries that are pushing leverage, eroding documents, pushing down pricing. And in the private world, the lenders are sticking up for themselves. And the level of control, which is utterly critical, lights out much better in private credit. So you're getting an asset that is higher yielding, controlled by the managers that you're paying, and potentially much more diversified in the public markets. And ultimately, that should spell something positive. And this is a correlation table between the different silos of private credit amongst each other and between some public indices. And what you can see here briefly, this is a bit of an eye test, is that the correlation is very low in between silos, among silos, and also to the public markets. And so that's really important because that means you can potentially increase your returns while reducing your risk. And this is what you guys over at Calamos did. You guys actually put in a notional portfolio based on historic data and Axia's data, so publicly available data and our data. And we took a 60-40 portfolio, we lopped it in half again and said, okay, 10% in high yield and 10% in bank loans. And then we swapped out each of those two slices for a slice of private credit. And then we swapped both of them out for a slice of private credit. As you can see, standard deviation, which is the x-axis, declined and moved closer to the origin, closer to zero. And you can see that return rose. That's moving away from the origin on the y-axis. This is not a guarantee of performance, obviously. And this isn't going to happen in every fund. It depends what private credit you own and what else is going on in your 60-40. But we believe that certainly directionally, you can increase your returns and you can also reduce your volatility. And that can be a powerful addition to anyone's portfolio. Is that kind of where you were going with the question?
And that was, and I'm going to ask a question that's the source of the data. And so, public market, tons of information available about the investment characteristics of your options. Private markets, how difficult is it to come by, and who has that kind of information? Where do you find it?
Yeah, it's hard. It's really, really hard. So the data used here is a combination of our own data and some third-party providers as well. And that's like 650 different funds, investments, SMAs, etc. We couldn't do this analysis without what Aksia had the data that we scrape. But we also capture a lot of asset level data. And this is really important because it's when you invest in a fund, all you really see normally is what is happening to your NAV. You don't know what's driving that NAV. And we identified this obstacle early on. So what we do is we ask for 100, I think it's about 100, maybe 90 something data points from the GPs that we work with. EBITDA of the underlying borrower, loan to value, coupon, spread, covenant. We ask for all this information. As a result, we have info. We've collected over the years info on 17,000 different middle market loans that no one else has. And currently that's down about 5,000 because many of those are paid off. So it's super hard. You may recall, Mike, I mentioned in the first slide that we have 30 professionals globally and working in private credit. We have 60 people in ODD and we have 42 in private risk. Well, those 42 people are responsible for collecting the data on a quarterly basis from all the funds that we work with on behalf of our clients, organizing it, curating it, analyzing it, and feeding it to the investment team so we can make the best decisions real time.
Interesting. I'm going to turn the line of questioning to next. Now I understand private credit. I understand it has interesting investment characteristics, attractive investment characteristics, and how do investors what kind of vehicles do they invest in that has built this market? And my sense is it's been dominated by institutional investors, that their bite sizes are very large, and they're probably paying a management fee and some kind of carry, and that creates the void for investors that may not have the same scale to be able to access this. Just comment a little bit about the access vehicles for institutional investors, because the next thing we're going to turn to after this is there is now a movement to create greater access to private credit investment characteristics to a broader market than solely institutional. But let's begin with the characteristics of what the institutional investor would have by investing in a private fund.
Sure. So there's two sides to that. I'll answer the institutional question, and then I'll transition over to individuals, which individuals had access, and then we can talk about the next thing, which is the democratization, which I'm very passionate about. So institutions typically will invest in a closed-ended partnership, and LLC. There'll be an LP, there'll be a limited partner, and the fund manager, you mentioned a couple, BlackRock, it could be Apollo, Ares, it could be firms you've never heard of, Breakwater, Crestline, LCN, LCM, et cetera, Tor. They'll be the GP, the general partner. And the way to gain access is you have to be an institution. You have to have a minimum, anywhere from $1 million to $10 million. You sign up for a long time. You usually locked up for 7 to 10 years. And you pay a management fee. And you pay a carry, which for those people who might not know on the call, the carry is really a profit share over hurdle rate. So if the hurdle rate's an 8% return to the LP, the GP might get 20% of profits over that 8% hurdle, whatever that hurdle might be. And so that's generally how institutions have accessed private credit and private equity as well. It's very similar. There's been a move towards more evergreen vehicles where the access is more frequent, and you can get out a lot easier. And there's a critically important point to be made here. And I don't want to talk too much, but it's important. The challenge of private credit investing in a finite lived vehicle is 100% of your capital is never called. Generally, in these closed-ended vehicles, private credit managers only call about 80% of capital, maybe 85%, because they need dry powder to help with their borrowers should that need arise. In evergreen vehicles, it's different. Because there's constant access to capital, those vehicles tend to call 100% of capital. Okay? Was that a legit answer, or do you want me to?
No, I thought that was excellent. So you brought up the word democratization, call it the broader access of private credit strategies to a broader investing audience. And Calamos teamed up with Aksia to create access to a broader audience. And I'd like you, and you obviously know the institutional space very, very well. And as you tackled the idea of creating broader access, more democratization, tell me the decision trees or decisions that you had to make in terms of being able to offer private credit in a interval fund format. That means there's a price that's struck every day. It means that there's quarterly liquidity. You still have illiquid assets. You have to balance a lot of decisions to be able to deliver and design a fund. if you walk us through a little bit of your thinking and some of the decision points you had to make to get there.
Sure. So I want to touch on democratization because I don't know, for some reason this really speaks to me, and I posted on LinkedIn about this. Before this vehicle, there were really only two types of individuals that could access private credit. The first is what I have here, which is anybody who has a public pension plan. Private pension plans are far rarer, but 68% of our clients, and half of our clients are pension plans, 68% of allocations to private credit. So if you're a former teacher, like my mother, if you're a former firefighter like my father-in-law, cop, judge, municipal employee, you have access to private credit. It's part of your benefit when you get paid out is generated by private credit. At the other end of the spectrum, what Tom Wolfe called, I hope people are old enough to remember Tom Wolfe and the Bonfire of the Vanities, what he called the masters of the universe, right? The really wealthy individuals. Believe me, the wealthy individuals are not running, so I shouldn't say that. The multi-millionaires, the masters of the universe, are probably not running 60-40 portfolios. They've got a lot of allocation to alts for different reasons, in part because of the risk-return trade-off. But no one in the golden mean could access that. No one who was in your upper or middle class could get access to that because they're probably not going to be municipal employees. And they probably don't have $5 million in net worth, excluding their home. Okay. And so the challenge is, how do you find something that can bring this very important asset class to people who don't have it and who are restricted in what they can buy, by regulation? And I think that was the question you're getting to, as to how do you thread that needle, right?
Right.
Yeah. So the first thing to think about is the liquidity of the vehicle, right?
Yep.
Yeah. You can't really offer daily liquidity. What private credit managers invest in, and what our interval fund obviously will be investing in as well, are known as level 3 assets. And that's FAS 157, which basically divides up assets into different levels. Level 1 is, Apple stock, Alphabet stock, whatever. It's liquid, bid-ask spread is infinitesimal, and it's constantly traded, transparent. Market price discovery is not even an issue. Level 2 is kind of less so. Think high yield bonds, things like that. And level 3 are assets for which there is no real, market. You could put your home there. You say your home is a level 3 asset, right? Because you don't really know what the price is. Discovery requires you getting 4 or 5 real estate agents to come in and help you out. You can't just sell it. You got to have people have to come look at it, and offers, et cetera. And so what we invest in are those level 3 assets, those bilaterally negotiated assets. And they're not liquid. They're just not liquid, just like your home isn't terribly liquid. And so you need a vehicle that allows the portfolio managers to hold on to those assets without being exposed to the vagaries or the technicals of the market. And an interval fund does that. An interval fund requires that the fund sponsor or manager provide 5% at least every quarter in redemptions. That's a good balance, right? You want to give people the chance to get out, but you can't be subject to what the market's doing, because you just will never be able to get a good portfolio of level 3 assets built. They're too hard to find, too hard to structure, too hard to curate. And so an interval fund does just that. Interval funds require 5% of NAV redemption every quarter at least. And that's what we're going to be doing. We can go up to 7.5%. That's of NAV. So if an investor is less than 5% of NAV, he or she can get his or her money out 100% at the end of the quarter. Obviously, if they're not, they've got to wait and get out pro rata. So it's a really good structure. Next thing you have to think about is how to preserve that liquidity. It doesn't do you any good to have an illiquid vehicle with a liquidity window and you have no way of meeting that. And so different firms do things differently. I think we do it the best way that I've seen in the market, frankly, which is, you guys at Calamos are managing a 10% liquidity sleeve, and we're going to have a leverage line of about 10% in NAV that's going to remain uncalled. that's a full year's worth of redemptions before we have to start thinking about what we're doing in the level 3 portfolio. And I think that's really powerful. And I imagine others will start adopting this approach too as they come to market. And finally, there's the pricing element to it. Some interval funds view themselves as purely private credit, and they charge a management fee and a carry, just the way they would charge an institutional investor. And we haven't done that. You know as well as I do, we're only charging management fee and no carry. We think that that's kind of more fair and more in line with what people can invest in elsewhere. Nowhere else. You don't invest in stock with carry. You don't invest in mutual fund with carry, right? So, at least I don't. I don't know. Maybe they're out there, but I don't.
I appreciate that, those comments. Let me, last topic we'll turn to before questions is how, and as you know, and this is RPAG and their advisors, all of their advisors, I believe, focus on retirement plan sponsors. Many of the advisors also have an associated wealth management business. With a LLC, you have in DC world, you're not you have a completely illiquid vehicle for 7 years. You lock it up but with an interval fund, you have a price that is declared every day with
Correct.
limited liquidity. And what we've seen in the DC market is we can look to private equity, which has been very active in promoting access to private equity for defined contribution plans. And you've begun to see the inclusion in defined contribution plans of private equity through target date funds, certain balance funds, certain custom vehicles. And I would suggest that private credit could play a similar role for those advisors that do custom target date funds or balance funds, where they would consider a portion of that vehicle of that vehicle's assets in something that has limited liquidity, like an interval fund. So that's where, and then there will be for these advisors certain sponsors that may have an associated pool that they can provide management for, where this could, rather than being participant directed, could fit. It also fits in their wealth management business, which is a big target of what we've done where interval funds are being bought. And so, and you already showed some of the scenarios associated with improved risk return characteristics when including private credit. So for the audience, I would say limited ability to use in defined credit, in defined contribution plans. If that's a topic of interest, love to chat. And then nextly on the wealth management front, private credit funds have grown significantly through interval fund type delivery vehicles, and that growth has taken place over the last 2 to 3 years in a different rate environment than we have now. Can you compare and contrast, funds that were created 2 or 3 years ago and funds that are being created now from their investment characteristic standpoint?
Yeah, in fact, I just posted on this on LinkedIn. I'll be posting again a little bit later. Look, the base rates have increased by 5.5%. Posted this on LinkedIn. For every turn of leverage. So as some of you may not know, an LBO is maybe 6 times EBITDA, 7 times. So when you hear about leverage, 6, 7, that number refers to the multiple of EBITDA. A 5.5% increase in base rates, which is what we've seen over the past 7 months, 8 months, 9 months, longer actually. 5.5% increase in base rate translates into 5.5% of EBITDA going out of private equity and into the lenders' pockets for every 1 turn of leverage. So if you have an LBO that's 6 times EBITDA, has borrowed the equivalent of 6 times its EBITDA, it's now sending 33% of its EBITDA in interest payments, more than it had anticipated. You look at coverage ratios are coming down because, when CFOs are borrowing in 2020 and 2021 at SOFR, which is the new LIBOR, plus 6 or plus 4, plus 5, whatever, they thought they were borrowing, at almost zero plus that spread of 6, 4, 5, whatever. They're now paying almost double because the base rates have increased. So that's super important. And so the other point I wanted to make about this is that this is mainly what I'm talking about, mainly impacts legacy direct lending portfolios. Now that things have turned around, lenders are taking a different view of things. You look at a business differently when base rates are zero than when you do when they're 5.5%. And you're taking all kinds of different precautions, and it's a sobering experience. Believe me, I'm a former underwriter. It's a sobering experience to see that. And so we're seeing a lot of good opportunities, really all across the board. So vintage matters.
Thank you for that, and we'll conclude on that note. Thank you for allowing us to be with you today to share our thoughts on private credit. And of course, if you have any questions, we'd be happy to engage in a conversation or answer them.